Hi, this is Matthew Cratter from Trader University, and today I want to answer one of the more common questions that I've been getting these days, which is why do stocks keep going up? If you want to learn about how the stock market, options market, futures markets actually work, or if you want to just see what I'm trading during this financial crisis or at any time, be sure to hit that subscribe button. So we've got a really weird situation, which is why this question keeps coming up. We now have close to 22 million unemployed Americans. We even have a Fed president, Minneapolis Fed president, Neil Kashkari, saying that this recovery from this pandemic is going to be a long, hard road. And yet what we're seeing in the stock market is something that looks like a V-bottom. It's still a little too early to tell, but this is a chart of the S&P 500, SPY, ETF. We did get a death cross a couple weeks back, where the 50-day moving average closed below the 200-day moving average. Now, this can be a bearish signal. It can definitely herald the beginning of a multi-month or multi-year bear market. It can also occasionally provide false signals. And if we go back, we can see there was a similar dip back in the fourth quarter of 2018, where we had a sell-off. The economy was beginning to price in a recession, and then we got a V-bottom. And the 50-day moving average crossed back up, and then it was just really off to the races again. So the question becomes, is this a V-bottom like we saw in the fourth quarter of 2018, or is it something else? Now, back in late 2018, the market was pricing in a surmise that the U.S. economy had rolled over into a recession. We do know that because of the pandemic, the U.S. is in a recession now. This is almost 99% certain. And these recession numbers, these economic numbers, will always come out on a delayed basis. So by the time we actually hear that we were in recession, the recovery may, and that's a big, we should put stars around it, may or may not have recovered. So this is the situation where we're facing. And stocks, I have to admit it, I've been a bear, but they've been very strong. And on Friday, we just got to close above the 50-day moving average. So that is the real question. If we're in a bear market, what will happen is we will bounce off of this level, and there'll be another leg down. So another chart I wanted to show you, and we are going to get to some fundamentals in a moment, so bear with me. This is the Bollinger Bands on the 80-week Bollinger Band. So this middle line is the moving average, then we have two standard deviations up and down. If we look at this, we've basically bounced all the way back to the middle line. Very similar to what happened in the fourth quarter of 2018. We did go a little bit deeper this time. We got outside the bands, but we've gotten back to the middle band almost. And again, this may serve as a resistance level, overhead resistance, but we've gotten all the way back there much more quickly than I would have guessed. Now, if we go back and look at similar situations, this is that same chart. This is today right here. This is 2018. You can see there were a couple similar things back in beginning late 2015, early 2016. But if I wanted to go way back and take a look at the last two bear markets. So in 2007 to 2009, we basically got this first leg down in stocks where we closed below the lower Bollinger Band, bounce back up to, not quite as quickly as this time, to the moving average. And then you can see there was a lot of pain ahead once we bounced off. So that would be one model. What argues against it is that we've bounced back more quickly. What argues for it is that the depth of the initial sell-off was deeper this time, which suggests that perhaps there's more pain to come than there was in 2008. Now, the other example would be, let's take a quick look at the bear market of 2000 to 2002, see what this looked like back then. So let's see. Market peaked really the summer, late summer did a double peak in March of 2000, and then the late summer of 2000. I remember this very well. This was a little bit less of a bounce. You can see that we came all the way down. We bounced in early 2000, call it spring of 2001, but we didn't get quite back up to the Bollinger Band. And then we sold off sharply going into September 11th, and September 11th really just accelerated it. And if we scroll out, we can see that this was a much more smooth sell-off with these waves going down. Now, most bear markets, and I've shown you this before, that bear market of 2000 to 2002, we sold off 49%, and the bear market lasted 929 days. The 2007-2009 bear market, we sold off 56%, and it lasted over 500 days. So we're definitely, I think our max point of sell-off intraday was 35 or 40% this time around, but it's been really only, call it 2 months, maybe even less than 2 months. So if we see a recovery from these levels, this will be the fastest, not only the fastest crash, the crash in February and March was faster than even the stock market crash of 1929, the famous one that initiated or set off the Great Depression. So the crash was faster this time around, and the recovery's been really fast as well, which is the reason a lot of people are scratching their heads. So there are really two main camps here that we can think about. I think Jesse Felder, who's a very smart guy, worked for Bear Stearns and not responsible for its collapse, hopefully, and ran a hedge fund. He's a very smart guy. So he sees this as a W sort of situation where you have a big initial sell-off, you have a bounce, and then you have another sell-off. And it could be a lopsided W where you get a lower low before coming back up. Something like that. So in Jesse Felder's mind, this is similar to what happened in 2008 and 2009. He would say that we're probably somewhere around here. We've had this huge bounce off the bottom, and he calls it the second chance rally because it gives you a chance. If you think things are going to go lower, this is the chance to panic, the best time to panic and lighten up on your equities, if in fact we're going to get sort of a slanted W like this. Now, he's got other examples, and I'll link to these tweets, similar things happening in 1929 to 1932. You can see these sort of W patterns or extended W patterns where you had really quite large rallies. So 48% bounce in late 29, 23%, 29%. Likewise, in the bear market leading into really the bear market that World War II finally got us out of, you had some impressive bounces here of 24%, etc. And then a 29% bounce in 2000 to 2003. Huge milestones like this can lead one to believe that the worst of the coronavirus-fueled crash in stocks is over, but that incredible bounce is much more likely to be the first of at least a few bear market rallies. So this would be that argument, the W one. Lots of people are pointing out that Amazon, the skew on Amazon is quite high. In other words, people are buying calls over puts, and we've gone really from extreme fear back to extreme greed in Amazon. And I thought this was an interesting, and so this person's interpreting this as being a bearish signal. Now, Amazon is obviously one of the leaders of this market. This is a chart or a table of, or I would call it a heat map of individual stock performance in the S&P 500 for 2020 year to date. You can see that there's a sea of red, and then very few, not a whole lot of green. So we've had a complete collapse in the financial sector. Bank of America, JP Morgan, Wells Fargo, all these banks down 30 to 40%. We've had a collapse in industrial companies, General Electric, Boeing, Caterpillar, etc. We have had the real standouts can be summarized fairly easily. We have Amazon, obviously taking huge market share. A lot of people discovering that it's very nice to have groceries delivered from Whole Foods. You can order anything you want from Amazon. So a lot of people who maybe weren't Amazon customers using their services now, and because it becomes so easy once you set up an account, they'll become permanent lifetime customers of Amazon, and maybe not shop at their local Kroger's or Safeway anymore, etc. Netflix, for obvious reasons, a lot of people probably signing up for that if they're people who still don't have it. These are the shelter-in-place stocks. Microsoft taking market share from rivals. And then there's really not a whole lot of green. We can see some drug stocks here: Gilead, Eli Lilly, Johnson & Johnson. There's a little green there. Walmart, Dollar General, some discounts. Behemoths will also do well, take market share. We've got the sea of red in the oil energy complex, which we've talked about in previous videos. We've got Newmont Mining up on the year sharply, obviously a gold miner. So really, apart from these behemoth monopolies like Amazon, Microsoft, Netflix, etc., drug stocks and gold stocks. And because the way the market indices are weighted, these really large market cap stocks like Amazon and Microsoft drive a lot of the rally that we've seen. And this is just, if you think about this, is an enormous move for, call it, $1 trillion company to be going up 20, 28, 30% in a year. Now, there's an alternate hypothesis, and this will be more controversial. Now, basically, if you have sort of normalcy bias working for you, where you think things are going to work the same way they've always worked in the past, where the Fed bails everybody out and times get good, even if that is true, this recovery has been very fast and very strange. And so, if you don't think it's a W, there's another hypothesis, and that's to look at what stock markets have done when their central banks have printed a lot of money. So there's a great quote here from Kyle Bass. Zimbabwe stock market was the best performer this decade, but your entire portfolio now buys you 3 eggs. Remember this quote when you see the stock market going up on horrible earnings, and I could add unemployment as well. So obviously Mugabe ran Zimbabwe for a very long time, destroyed the economy, printed a lot of money, and we could go into the complex reasons for this, but what really happened is they reached the point where you could have something like, here's the Central Bank of Zimbabwe, the Reserve Bank of Zimbabwe, and they had to start printing $100 trillion bills, Zimbabwe bills. So if you saw this and you thought of just the murder that happened and the corruption, the bribes, etc., and all the economic pain, you would think that they had a giant stock market crash. But this is where things get really interesting. They did not. Instead, the stock market actually did very, very well, especially the last few years. Now, this is the stock market, the Zimbabwe stock market, Zimbabwe Industrial Index, measured in Zimbabwe dollars, not in US dollars. So it did very well in its own currency. And one could be forgiven if one was sitting in Zimbabwe and maybe one was part of the wealthy population and owned a lot of stocks. I imagine most Zimbabweans do not own any stocks, but maybe thinking as you sit in your compound, wow, things are not doing that bad. Maybe Mugabe's doing a very good job. And because my stocks are up a lot, and they're up a tremendous amount. If you look at the index on here, really going from 200 to, call it 1600, so up 8x, up 800%. That's much more than we ever got in the last decade in the U.S. But where this person had a problem, if you're a stock market investor in Zimbabwe, is when you go to cash out your stocks and you get these nice $100 trillion bills, and then you try to go somewhere, and let's say you go to, you come to the United States and want to buy a car, or you go to Europe, you will find that your Zimbabwe dollars are still don't have any purchasing power. So you made a fortune in the stock market, a quote-unquote fortune, but your entire portfolio now buys you 3 eggs. Because what's happened is that you basically had, I've analogized this to someone running in place. You're running, you feel like you're making a lot of progress, but you're not actually going anywhere because the currency is being devalued at the same rate as stocks are going up. And the currency is probably actually being devalued much faster than stocks are going up. And so it looks good when your stocks go up 800%. It's just amazing. It's like a venture capital return. But if the underlying currency is crumbling and losing its purchasing power, well, you're doing better than the average Zimbabwe person who has all their money sitting in these bills or sitting under the mattress, but you're still losing money overall, losing purchasing power, losing wealth. And no one would ever think that someone who was in Zimbabwe was going to be one of the richer people in the world. It's obviously a very poor and poorly run country. So let's do, maybe this is an aberration. Let's look at another example. Venezuela is another great example of a country where they had a lot of money printing by the central bank. And they had something really similar happen, where the stock market went from, in April of 2018, it was trading around 3,000, call it. And then by November of 2018, it was at 50,000. So it went up even more than the Zimbabwe stock market. Then you had another crash where it basically went down, call it 95%, 98%. And then it went up a lot. And here's a Forbes article that I will link to. This is dated February 5th, 2019, so about a year ago. And it points out that the Venezuela, the Caracas stock market index is up 200,000% year to date. Just in the first 2 months of 2019, the stock market went up 200,000%. Now this again is because of the currency being devalued. And so no one was getting rich from this going up. The currency was falling, almost certainly falling faster in terms of its real purchasing power, in terms of purchasing real things like cars, and as also its purchasing power against things like gold, against the US dollar. And so if you kept your money in Venezuela bolivars, and then you tried to come to the US or tried to buy imported goods, it would be virtually impossible because the money had lost so much purchasing power. Something similar happened in Weimar after World War I, where they had a similar situation where the central bank printed a lot of money, and yet stocks actually did quite well, even though at some point people had to fill wheelbarrows full of I believe it was called a Deutschmark back then, or just the German mark. They had to fill wheelbarrows with the local currency to buy a loaf of bread. And then the next day they'd have to come back with two wheelbarrows worth of bread. This is an interesting article I'll link to that points out that at the beginning of this rally, stocks in the German stock market had a 20%, a lot of stocks paid a 20% dividend yield, and stocks were pushed so high that the dividend yields went to 1% or below, which sounds very, very similar to the US. Now, obviously, here we are talking about mismanaged economies. The Weimar Republic didn't last very long and certainly contributed to the rise of Hitler. Venezuela, fairly corrupt. No one would argue that this is a well-run country. In fact, people have voted with their feet. Same with Zimbabwe. If you're in Zimbabwe, Venezuela, or the Weimar Republic, you tried to get out if you could, just because the living conditions and the social fabric decayed so quickly. But we're in the United States, or at least I'm in the United States. This is the U.S. dollars, the world reserve currency right now. And here we have the website of the Federal Reserve, which is the central bank in the United States. And I love this quote. The Federal Reserve, the central bank of the United States, provides the nation with a safe, flexible, and stable monetary and financial system. Now, if you've been trading since the mid-90s, as I have, and have seen one crisis come after another, and the Fed's policy become more and more crazy, it's hard to stifle a laugh when you read something like this. The monetary system is safe, flexible, and stable. If anything, it's been the opposite of stability, and the trend has been to much more severe financial crises. So 2000 was bad. 2008 got really scary. This latest, at least the first couple months of 2020, were even more scary in terms of things blowing up. Now, it's hard to reconcile something like this, where saying that the Fed provides safe, flexible, and stable monetary system, when you juxtapose it with recent stories. The Fed is going to buy muni bonds. They're going to buy junk bonds. And junk bonds are just what they sound like. These are companies that have to pay very high interest rates simply because they're so badly run, or they have so much leverage, or they're losing so much money. And so we have this weird thing where it's like the saying, "Look at what I do, not what I say." When you have a central bank that's actually printing money, and I'll run this again. When you have the money printers going and they're being used to buy junk bonds and to prop up companies that have been poorly run, that suggests that things aren't completely well in the United States. And this obviously affects everyone simply because the US dollar is the reserve currency, the world reserve currency. Central bank printers going off in Asia and Japan and China, Europe, basically everywhere. Now, what happens to the US dollar over time? We have the saying, it's a safe, stable monetary system. And instead we see that since the Federal Reserve was started, the US dollar has lost 95% of its purchasing power since 1913 and 98% of its value against gold. This suggests that the Federal Reserve, at least over long periods of time, is actually not providing a stable monetary system for the US. Instead, when you print a lot of money, the money becomes less scarce, less rare, and hence it becomes less valuable. This is what happened in Zimbabwe. This is what happened in Venezuela as well. Now, even people like Warren Buffett, who are known for hating Bitcoin, hating gold, if you search hard enough, you can find quotes where he talks about how the US dollar is going to decline in terms of its purchasing power over time. So this is a interview from 2017, or an article from 2017 that quotes Buffett from 2011. Buffett warns, "If you ask me if the US dollar is going to hold its purchasing power fully at the level of 2011 in 5 years from now or 10 or 20 years from now, I would tell you it will not." And so this is one reason Buffett likes to be in stocks, obviously. Now it's interesting that he's against gold. So some of you may ask what purchasing power means. It is sort of what it sounds like. So for example, Big Mac in 1970 cost roughly 45 cents. Today, a Big Mac is anywhere from, call it $4 for just the Big Mac by itself. So the price has gone 10x in the last 50 years. This is not what happens in a stable monetary system. Something similar has happened to gasoline prices. Now, obviously, gasoline prices are temporarily very low because no one's driving during this pandemic. But gas prices, on average, were roughly 36 cents a gallon in 1970. 50 years later, well, in California, just a couple months ago, gas prices were around $5 when I was there, closer to $2 or $3 in Colorado. And so this is what you have as a situation where the currency, the US dollar, its purchasing power is going down because we're printing more dollars all the time. Now, when we looked at the map of stocks that have done well this year, we pointed out Newmont Mining up 36%. This was one I've been talking about for a while, if you've been following me last year as well. Gold obviously up a fair amount, especially for a dirty yellow metal, as lots of people like to call it, up 13% year to date. So not doing as well as Amazon, but still doing quite well. Bitcoin as well is back up to right now. It's roughly trading where it went out last year. Last year it closed at about 71.50. It's at 71.46. So it's been a volatile ride with Bitcoin, but it has held on to its value since December 31st, 2019. Something very similar happened with gold, where we did get a big sell-off, and now gold is up. So what happens in a liquidity crisis, people dump assets to raise cash, and they were dumping gold, they were dumping Bitcoin even more. Bitcoin is not a regulated market, there are no circuit breakers, and yet here we are, it's bounced all the way back in a year when the stock market is still down. So what this suggests to me is that our situation is actually closer to that of Zimbabwe or Venezuela. It's not nearly as bad. We're not printing money at the same rate. We have a rule of law. We have property rights, etc. Here's a great chart from Jesse Felder. Looks like he's quoting a Bloomberg article. If we regard gold as the continuing true measure of monetary stability, it suggests that stock market gains in the last 50 years, so that same period when the Big Mac went from 40 cents to $4 and gas went from 40 cents to $4, all the stock market gains can be attributed to just the dollar going down. So you have a similar situation, not quite as extreme. In Zimbabwe, you print a lot of dollars, or Zimbabwe dollars, stock market goes up. In Venezuela, you print a lot of bolivars, stock market goes up. Weimar Republic, the same thing. And so there's a very interesting chart basically that normalizes S&P prices back to sort of anchors them in 1971 terms, which is when the U.S. dollar left the gold standard, when Nixon did the so-called Nixon shock. And if we the red line here is the S&P 500 in dollar terms, and then the black line is the S&P 500 price of the S&P 500 divided by the price of gold, that ratio. And the suggestion is that we've had productivity gains. We've had amazing things invented, the PC, the iPhone, a lot of, especially in the area of software and hardware and semiconductor chips. But this suggests that a lot of the stock market's rise, and one reason the U.S. stock market has always gone up over long periods of time, is simply because you have the U.S. dollar losing power over time, purchasing power over time. So where am I going with this? What I'm suggesting is it may be that the tremendous money printing we've had, the fiscal bailout packages, as well as the Fed's monetary policy, printing trillions and trillions of dollars, this sort of thing, well, I lost the video there, has been what is causing this bounce. And so it is quite possible, if the Fed wants, they can pull Zimbabwe on us. They can keep printing money, and they can drive the stock market to new highs. In the process, what will happen is a lot of small businesses will go out of business. All the competitors to the big companies, their business will be sucked out by these giant monopoly businesses like Amazon. And as a result, the wealthy could continue to do very well. But what you could see a sort of mini Zimbabwe version where the general population does very badly, but the stock market does well, even in the face of millions of unemployed people. And if we start printing money for the purposes of UBI, so where we are now is we're still really at the point where the Fed prints money and buys assets with it, prints money and buys bonds, prints money and buys, props up money markets, etc. The Bank of Japan has been buying equities for many years, so this would be the next obvious step. We've had Janet Yellen come out and say that the Fed should be permissioned by Congress to buy stocks. And so this is quantitative easing. This is where you print new money and you buy financial assets, which benefits the wealthy much more than the non-wealthy who do not own a lot of real estate or a lot of stocks. And you can do quantitative easing like this, money printing, up to a certain point. But if you do too much of it, you get such a big gap between the haves and the have-nots. And you have the wealthy eating special hamburgers that have gold, slivers of gold in it, or going on building extravagant houses, etc. And you get, at that point, you get sort of a French or Russian Revolution situation where the wealth gap becomes so large that you get some form of revolution. So then the next stage is you print money and just give it to people directly, and either in the form of services or you just send them a check. And we've already had the first $1,200 checks go out. There's talk of this bill where every American under a certain tax bracket will get $2,000 a month until employment comes back to its previous very, very low levels. In this sort of situation, you have a huge devaluation of the dollar, and a devaluation of the dollar at a much faster rate than has happened over the last 100 years. The U.S. economy was, you could argue, was fairly well run since 1913, so the last 107 years. And yet, even under this much more conservative policy, because for the last 100 years, until recently, we haven't been printing money and buying U.S. treasuries and sterilizing the debt. We haven't been printing money and buying junk bonds. But now we're at the point where we're really going to print money, bail out all the hedge fund guys, bail out all the private equity guys, increase the wealth gap. And then to counteract that, we're going to print even more money and give everyone free money in the mail. So you could have a situation where people go back to work for a few months, then the virus comes back, they have to stay home, but they get very used to a lifestyle where they're shopping at Amazon, they're shopping at Netflix, which is good for the billionaires of America, and they're using their checks from the government. As the government debases the currency and keeps sending them money, these stocks continue to do well. But what happens is you begin to get some real inflation in the system, and you get the stock market. Stock market could certainly go to new highs. Stock market could pull a Zimbabwe or a Venezuela, but the purchasing power for the average American will go way down. And so you'll have this very strange situation where the government has to print even more money because prices are starting to go up. And so the government has to print more money just so people can afford to pay the rent and afford to buy groceries. Meanwhile, robots begin to run everything. Amazon, most of the company has been or can be run by robots. And so you have this pressure that keeps a lot of people unemployed, keeps people needing those UBI, those unemployment checks, universal basic income checks, and at the same time, the Fed is monetizing the debt and continuing to print money. So I wanted to leave you with a final chart, and I know this has been somewhat inconclusive, and you're going to have to decide for yourself: are there a couple more legs down here in the bear market? Is it a W situation? Or are things really different this time? Because the Fed has been so aggressive, printing trillions and trillions of dollars, that we do get a very rapid recovery. But at the same time, gold does really, really well. Stocks hit the new highs maybe, especially the big tech monopolies do well. But gold does really well, and Bitcoin does really well. And I thought this was interesting. There's an overlay here of the Deutschmark and Bitcoin. So the black line is the value of one gold mark in paper marks. So a gold mark was actually backed by physical gold. A paper mark was not, and you can print as many as you wanted of them. And you can see that in this chart we had the black line, the value of this is the Weimar Republic, obviously German money. It goes from, call it 10,000 to, I can't even read what this number is. I think it's a trillion. And Bitcoin has since its invention in 2009, this is it's sort of tracked this. And so the idea is that you can print as much money as you want, but you cannot hide that money printing from the thermometers in the room. And those thermometers would be things like scarce real estate, gold, and Bitcoin, where there's a fixed supply. And so if you print more money, the value of these things that function as stores of value, that actually preserve wealth by going up over time, will go up over time. Now, gold has been slightly less desirable because it's very difficult to move around. It can be dangerous to store. You don't want people coming to your house to ignore it. Bitcoin, obviously much easier to move around. You can send it across borders. You can store it in your head, and it's very easy to subdivide and spend if you need to. And it's also even rarer than gold. And it's about to be, after the May 2020 halving, essentially the production of new Bitcoin is going to be halved. And this is going to lead to even further scarcity. And if demand stays constant and supply is halved, you can imagine the analogy that I think Anthony Pompliano uses, that what would you think would happen to the price of gold if you heard that in 4 weeks from now, half the world's gold mines were going to close? This is something similar happening with the Bitcoin miners. And so going forward, I'm a little agnostic about stocks. I don't have a strong view at this point whether we're going to see another leg down, sort of W-like sell-off, or whether we're going to see our own mild version of Zimbabwe and Venezuela, where the powers that be, especially the central bank, the Fed, decide print, print, print. We need to bail out the rich. We need to keep some semblance of a real economy. And it's going to get very strange when people are just staying at home collecting $2,000 checks, watching Netflix, and ordering from Amazon. But the way you will know that that there's something wrong with the system, even if stocks go back to their new highs, if we see a continued run in gold, and if we see a continued run in Bitcoin, you'll know that it's more due to the money printing rather than to underlying productivity gains or underlying real growth in the economy, rather than just growth that is juiced by central bank money printing. So my bet is on Bitcoin. I'm expecting it's right now around 7,000. I'm expecting it to go above 100,000 in the coming 12 to 18 months, and eventually to be trading in the millions. I think there's a very high probability that this happens. Again, it's a risky investment. It's either going to zero or it's going to millions of dollars, which makes it an interesting investment. It has sort of call option properties where the most you can lose is what you invest in it, and you could still make 100x or 200x or 300x on your money. If you're interested in Bitcoin, I have some more videos on Bitcoin that really drill down into it that I will link to below. Hope you guys found this helpful. I'm still trying to decide between these two paradigms of the continued bear market or the rapid recovery driven by the central bank money printers. Let me know your questions or comments in the section below, and hit that subscribe and like button if you found this helpful. Hope you're all staying well, and I'll see you in the next video.